The way the world's evolving, geopolitically, trade-wise, economically, we're in for some turbulent times ahead. More and more countries are trying to be less dependent on the dollar.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials for Memorial Day through June 2nd, 2025, while supplies last. First this week, we featured 2025 1/10-ounce gold eagles at just $59.99 over melt. Next, backdated 1-ounce silver eagles are just $4.79 over spot. And finally, constitutional 90% silver dimes and quarters are just $1.99 over spot. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.
Hey everyone, this is Elijah K. Johnson with Liberty and Finance. And back with us today is our good friend Mario Innecco from the very popular Innecco 64 YouTube channel. Mario, thank you so much for joining us today.
You're welcome, and thank you for having me again.
Well, it's great to have you. I did want to discuss something that you recently reported on, which was China's pilot program with insurance companies over there. China's, allowing them to invest in gold, have 1% of their portfolio in gold. So your perspective on this and how it could impact the gold market going forward.
Yes, I think it's like an expansion of what governments and central banks have been doing, especially China and the other global South nations. They've been increasing their net holdings of gold over the last 3.5 years. And I think now the Chinese are thinking, well, we need to get financial institutions to do the same. And I don't think they had any provisions for insurance companies. So they announced in February that they could have up to 1% of their assets in gold. And Elijah, the more I see the way the world's evolving, geopolitically, trade-wise, economically, I think we're in for some turbulent times ahead, and I think more and more countries are trying to be less dependent on the dollar. So this is just normal, and I speculated in this recent video because this is kind of old news, but my speculation is that eventually this provision for insurance companies could go up, maybe 5%, maybe 10% in a few years, and it wouldn't be surprising because if you look back over 100 years, most central banks they held like almost 90% of their assets were gold. So why shouldn't financial institutions also do so? And that was the premise of my argument.
I think it's important to remember that right now, so few people are invested in gold, and even China just saying, insurance companies can put 1% into gold is, that's still pretty small. So this idea that, gold is, has been skyrocketing over the last 1.5 years, and maybe we're at a top. I mean, we definitely could see a pullback from here as we have, but it's not, there are no signs to me that things are in a bubble because really so few people are actually invested in the space.
Yeah, and if you look at the, aside from the sovereign nations buying gold for their central banks or treasuries, if you look at the so-called smart money, the family offices, I saw something from UBS. I think it was in Gold We Trust, the Ronald's shop in Liechtenstein, Incrementum AG, that's what the name I wanted. He had a bar chart, and these family offices are like private hedge funds for the most wealthy families on the planet. They still only hold 2% of their assets in gold. It's not much, 2%, and 1% in commodities. And the rest is still mostly stocks and bonds, private equity. So yeah, the public hasn't even really put their toes in the water as far as gold and silver are concerned. In China, though, they're also pushing. They've been pushing for the last few years for the public to buy gold. They have special gold accounts. You can open a gold account at a normal bank. I mean, we can't do that here in the UK. Banks haven't dealt with gold for decades here. So yes. We're still not even in the mania phase at all for gold.
I did want to kind of see the flip side of the situation as well. So a lot of this move into gold is driven by a lack of faith in the US dollar. China seems to be moving, and other countries slightly away from the US dollar. And we look at even a recent treasury bond auction, you've mentioned very weak demand. So what is your perspective on the bond market right now, specifically the US treasury bond market? And it seems like, rates are rising, this lack of demand for US treasuries.
Yes, and it's not just the dollar that they're losing faith in. It will also be their own currencies because they've been a derivative of the dollar. But as for the bond market, yeah, there was a 20-year bond auction, I think last week, and demand wasn't great. The dealers, the primary dealers who work with the Fed, they had to step in to buy a little extra. Even the Fed stepped in. But I think, demand's still there. I mean, yesterday, I think they had a 7-year note auction, and then that went quite well. But as I spoke with you before we got on, there's a lot of talk now about a provision in the big, beautiful bill. It's a section in it, 899, and it talks. It gives the Treasury power to tax foreign investors, and some people are concerned that it could apply to U.S. Treasury coupon or income, even though there's like an international understanding now that you shouldn't have withholding tax on interest income from government bonds. So I think that puts more uncertainty into treasuries, and after August, I think there's going to be like $7 trillion to roll over only this year of all the debt that has been accumulated and hasn't been able to be rolled over because of the debt ceiling. I think it's a huge problem. The technical picture for, let's say, the 10-year futures and the T-bond futures doesn't look very good. And personally, I've been saying since 2020, 21, even 2019, that I thought we were near the end of the bond bull market. And that's been the case since 2020. Yields have been rising. We've had some kind of consolidation since for the last year and a half, but we could very easily see yields spike again. Maybe that's what Trump and Powell were speaking about yesterday at the White House. I know Trump told him that he was wrong not to cut rates, but I had a look, Elijah, since the Fed cut rates last year in September by 50 basis points, they cut another 2 times by 25. And the 10-year yield is actually up almost 1%. It was at around 360 when they started cutting, and it's now around 440. So I'm not sure if cutting rates is the solution. I'm not being partisan here. I'm just giving you the facts. But we're seeing a few weak numbers as well. We saw PCE today came in a little lower than expected, the core and the headline number, and we've seen jobless claims jump up to like 240. So maybe bonds will stabilize a little bit, but over the medium to long term, I think it would be a big problem for the Treasury, for refinancing, and the cost of interest expense. Even Elon Musk came out the other day and said he's not impressed with the big, beautiful bill. He said you can't have a big and beautiful. You can only have one or the other.
It is interesting how, starting this administration, there were hopes of, cutting the deficit, and Elon Musk coming in here with Doge, but now we have this big, beautiful bill, which it's a great name for it, right? It's fun. But the idea that, all this spending is just going to make things better, it seems like completely reversed of where we started.
Yeah, and I heard President Trump saying, because a reporter asked him about the deficits and the bill, and he said, and it was, they were referring to Representative Thomas Massey, and he said he doesn't know what he's talking about. He doesn't know about government. And the thing is, we need to stimulate the economy to solve, to fix things, which to me sounded like a Keynesian strategy, not a strategy where you're trying to cut the size of government, cut taxes, which is a good thing. I don't disagree with that, but you need to cut government spending as well, and that's not being done.
It seems like there are pushes by this administration to make a weaker dollar. Idea, of like that there's going to be inflation in the future, and I mean, it seems like it's kind of built in right now to the agenda.
Yeah, no, I mean, since the administration started on January 20th, the dollar has dropped from like 109 on the dollar index to around 100 right now. So yeah, it has come off. And I mean, it's the Keynesian fallacy as well, that if you devalue, your exports will go up and it will cut the trade balance. But I've never seen a country around the world, and there are many examples of this, especially in the third world, countries that devalue and debase their currencies. They never become wealthy and export things, because a lot of times you also have to import like intermediate goods or commodities to produce the finished goods, the manufacturing goods in the U.S. So if your dollar is weak, it's going to cost more. And an example of a country that has not really had a policy of devaluation is like Switzerland, even though they've tried their best to keep the Swiss franc as weak as possible with no success, because it's still a strong currency. And they don't have such a bad history of devaluation, and it's a wealthy country. So and that's the way I see it. And I think it is the policy of the Trump administration, a weaker dollar. And I think it will be particularly pronounced versus gold. But that doesn't mean to say, Elijah, that other countries are also not going to devalue versus gold. So it's going to be a race to the bottom. And that's why it's not just the dollar that's going down the drain. It's all of the fiat currencies.
And I think people are recognizing this, right? We have really seen bad inflation over the last couple years here. And this is probably people's, since the 1980s, first experience of, really high inflation. If inflation continues to, get worse, how are people going to be reacting? Because the government can't hide. They can only hide the inflation a little, right? They can say, well, it's only 2 or 3% or whatever. Just a couple of years ago, it was very obvious to everyone that inflation was way too high.
Yeah, I mean, we've had inflation for decades, if you look at the money supply, because that's the true definition. But I know what you mean, the CPI, that has gone up. And what was happening prior to 2022 is that every time the government and the central bank inflated the system fiscally and monetarily, all that credit and currency went into financial assets. This time, it came out of financial assets like stocks and bonds and went into consumer goods, and people feel it. And I think, yes, the government is how are they going to react? Well, they're going to tinker with the data. They're going to find new ways of revising the CPI, just like they've been doing since the 80s. If you look at Shadow Stats and John Williams, they've done it here in the UK in 2022. It chopped off like 1% off CPI. And the other thing they're going to do, I think, even if we have a Republican administration, they're going to bring in price controls. I think that's what Richard Nixon tried to do. And all of those things are going to fail. And people are not going to be happy. They're going to be more and more unhappy. Yes, you can try to get OPEC to produce a lot more oil and bring the oil price down, but that's not really bringing inflation down. It's just bringing oil prices down. So ultimately, I mean, the way to kill inflation would be to have a massive recession, massive Great Depression. That's the only way to eliminate a lot of that funny money that's been put onto the money supply over the last few decades, especially the last 15 years. So I don't see any politician, be it in the U.S. or in Europe, wanting to do the right thing in terms of that, because the general public still expects Peter to pay Paul. As I mentioned the other day, Frederick Bastiat, he said that the state is the great fiction by which everyone wants to live at the expense of everyone else, and it still applies.
What is the path forward here then to really get out of this system? Because we don't necessarily have to be affected by this reckless spending or reckless treatment of the US dollar.
Yeah, well, on an individual basis, we're more immune because we can do things that will help protect us financially, like having physical gold and silver, like getting out of debt, even though you could see the value of that be obliterated by inflation. The important thing about that, though, is that you have to make sure that you're able to carry that debt and not go bankrupt before the currency collapses. And so on a societal or national basis, it's much harder. And the only way that things are going to get better are either through a collapse of the system, like a hyperinflationary collapse, or a mega deflationary collapse, which I don't see, because when push comes to shove, the Fed will start printing and the government will start spending. We're seeing the government spend now, and things are supposed to be okay. So my money is on hyperinflation, and that's why I'm holding on to gold and silver, and I'm trying to live within my means. Also, it's not just about money, it's about being in good stand with your community and the people you live around. I think that's important too when money dies, so to speak.
And one last topic I did want to discuss before we let you go here is the yen carry trade. Now, we've talked about this on the channel before, but this ties into what we were talking about in the bond market, how it seems to be cracks in the bond market at the moment, specifically over in Japan with the yen carry trade. This actually could impact the global markets. If you want to tell us a bit about this latest development.
Yeah, I mean, we had a scare last August with the yen carry trade. And the yen carry trade is basically not just Japanese investors, but foreign investors borrowing very cheaply in yen and then taking the proceeds in dollars, euros, pounds, or Aussie dollars and buying high-yielding assets. And that's worked well the last couple of decades because the Japanese authorities, they've had a policy of keeping the yen weak and keeping rates at zero or negative. But now with rates all around the world going up, even though the Japanese central bank, the BOJ, is still doing like, I think, $40 billion of QE every month, they haven't been able to keep their yields, bond yields, low. For example, the 40-year has gone from like near zero or even negative 4 or 5 years ago to over 3% now. So what that does is that it makes the yen stronger because Japanese investors, they're bringing a lot of their funds home because they can get a higher yield in Japan. So that strengthens the yen. The people who have borrowed in yen, who did the carry trade, they're getting crucified on their borrowings in yen because the yen's going up in value and the cost of borrowing is going up. So what they do is they liquidate their higher yielding assets in the West and to close out that trade. And so the thing to do if you want to keep track of the Japanese yen carry trade is to see if the dollar is dropping a lot versus the yen. That's a bad sign. And also to see if the 10-year and the 40-year JGB yield, if they start going up and the yen starts going up, and that's bad. Right now, it's kind of stabilized, but it could affect U.S. financial markets, European financial markets, and it could have like a domino effect, contagion.
That's again something that I feel like a lot of people don't realize is how connected the financial system is. And we often don't even think about what's going on in Japan or with the Japanese yen. But the fact that, one issue here can affect, the whole world is kind of frightening.
Yeah, and I mean, the JGB market is the second biggest government bond market in the world. And the Japanese investors, they hold over $1 trillion of foreign reserves as well in other countries. So yeah, it's hugely important to keep an eye on the Japanese markets.
And if our viewers are interested in learning more, they can go to your YouTube channel, Innecco64. Can you tell us a bit about this?
Yeah, I mean, I'm the home of alternative economics and contrarian views. Started the channel in late 2015, so almost 10 years. The objective there is to warn the public about our current monetary system and also warn the public about interventionism, Keynesianism, and that there is an alternative, which is small government, sound money, and freedom, or the Austrian school recipe, so to speak.
Fantastic, Mario. Really appreciate your time today. Thank you so much, and God bless.
God bless. Thank you.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials for Memorial Day through June 2nd, 2025, while supplies last. First this week, we featured 2025 1/10-ounce gold eagles at just $59.99 over melt. Next, backdated 1-ounce silver eagles are just $4.79 over spot. And finally, constitutional 90% silver dimes and quarters are just $1.99 over spot. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.